If you were born before 1975, what happens inside the Social Security system starting July 3rd could quietly change the size of the check that lands in your bank account for the rest of your life. Not next year, not someday, this summer. And most people who will be affected have no idea it is even happening because nobody at the Social Security office is going to call you, mail you a warning, or knock on your door to explain it. The update is buried inside the way your benefit is calculated, the way your cost of living increase is applied, and the way certain earnings from your past are being reweighed right now. For some retirees, this will mean a small but steady boost. For others, it could mean a smaller monthly payment than they were expecting, higher taxes on the benefits they already receive, or a delay that throws off their entire budget. Before you do anything else today, you need to understand what is shifting, why it matters, and the simple steps you can take this week to protect every single dollar you have earned. Stay with me, because the part most people miss does not come until the middle of this video, and it could be worth thousands over the next few years. Here is the truth nobody likes to say out loud. Social Security is not a fixed frozen program. It changes almost every year. The formulas, the income limits, the tax thresholds, the earnings test, the full retirement age rules, the way spousal benefits interact, and the way Medicare premiums are pulled out of your check, all of these move. And when they move at the same time, like they are this summer, the people who get hurt the most are the ones who assume their check will just keep arriving the same way it always has. That is exactly the group being targeted by this update, people born before 1975, because that group sits right at the center of three overlapping rule changes. The first involves how your highest earning years are indexed. The second involves how the cost of living adjustment is being recalculated for mid-year reviews. The third involves how the Social Security Administration is now flagging accounts for what they internally call earnings record discrepancies. If your record has even one missing or misreported year, and many do, your benefit could already be lower than it should be. And the new July review process is the moment that either gets fixed or gets locked in. Before I show you exactly how to check your own record in under 10 minutes, do me a quick favor and tap the like button, because the more people who see this, the more retirees we can help avoid a costly mistake. And if you have not subscribed yet, hit that button too, because I post these benefit updates the moment they happen, not weeks later when the damage is already done. Let me explain why being born before 1975 matters so much in this specific window. People in that age group are either already collecting Social Security, about to file, or sitting in the delayed retirement credit zone where every month of waiting adds value to the check. That means any change to the calculation formula hits this group three different ways at once. If you are already collecting, the change affects your cost of living adjustment math. If you are about to file, the change affects your primary insurance amount, which is the number every future check is built on. And if you are delaying, the change affects how your delayed credits are counted toward your final benefit. A younger worker can absorb a small formula shift because they have decades to make it up. Someone in their 50s, 60s, or 70s cannot. Every dollar matters, every month matters, and a mistake at this stage can follow you for 20 or 30 years. That is why the July update is so important for this exact age band, and that is why the Social Security Administration itself recommends reviewing your statement at least once a year, especially in any year when rules are shifting. Now let me get into the part that surprises almost everyone. Your Social Security benefit is not based on your last paycheck, your average paycheck, or even your highest paycheck. It is based on your highest 35 years of earnings, adjusted for inflation using something called wage indexing. If you worked fewer than 35 years, the missing years are counted as zero, which drags your average down. If you had a year where your employer reported your wages incorrectly, that year is counted wrong forever, unless you catch it and fix it. And here is the part that hits hard. The Social Security Administration only gives you a limited window, generally about 3 years, 3 months, and 15 days, to correct most earnings errors. After that window closes, the mistake usually becomes permanent. Imagine working a full year, paying into the system every single paycheck, and then losing credit for that year simply because nobody told you to check. That is happening right now to thousands of people, and the July review cycle is one of the last clean chances many of them will have to catch it. If this is already useful to you, take 2 seconds to drop a comment with the year you were born, just the year, so I know who is watching and what topics to cover next. It also helps the video reach other retirees who need this exact information. Let me give you a real-life example so this feels concrete. Picture a woman named Linda. She is 68, retired 3 years ago, and gets a Social Security check every month. Linda worked from age 22 to age 64, mostly as a school administrator with a few side jobs in her 30s. When she pulled her earnings record for the first time after hearing about this update, she found two problems. One year in 1986 showed zero earnings even though she had worked the whole year. And one year in the early 2000s showed about $11,000 less than she actually earned, because a payroll company had reported her wages under the wrong Social Security number. Two small errors. But when those 2 years got pulled into her highest 35, they pushed out 2 higher earning years and lowered her benefit by about $41 a month. $41 does not sound life-changing until you multiply it. Over 20 years of retirement, that is nearly $10,000 she would have lost, plus the cost of living adjustments compounded on top of it. She filed a correction, brought in her old W-2 forms and tax returns as proof, and the agency fixed it. Her check went up, and she received back pay for the month she had been underpaid. That is the power of one 10-minute review. Now here is where the July change adds a new layer. Starting in early July, the Social Security Administration is rolling out updated internal review procedures that flag accounts with unusual earnings patterns, missing years, or mismatched employer reports. On paper, this is a good thing. It means more errors will be caught automatically. But there is a catch, and this is the part you absolutely need to understand. When the system flags your account, it does not always result in a higher benefit. Sometimes it triggers a re-verification, which can temporarily pause adjustments, delay a scheduled increase, or require you to send in documentation before anything moves forward. If you do not respond quickly, or if you do not even know your account was flagged, your benefit can sit frozen at the old number while everyone else around you sees their updates applied. That is why checking your account yourself before the system checks it for you gives you a huge advantage. Take a quick second to hit that subscribe button if you have not yet, because the next part of this video covers the tax trap that catches people born before 1975 more than any other group, and you do not want to miss it. Here is the tax trap. Many retirees do not realize that Social Security benefits can be taxed at the federal level, and in some states at the state level too. Whether your benefits get taxed depends on something called your combined income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. The thresholds where taxes kick in have not been adjusted for inflation in decades. That means every year as cost of living adjustments push benefits higher, more and more retirees cross those thresholds without realizing it. A cost of living raise that was supposed to help you keep up with grocery prices can actually push you into a higher tax situation, where part of your benefit becomes taxable for the first time. People born before 1975 are especially exposed to this because many of them have a mix of Social Security, a small pension, and required minimum distributions from retirement accounts, and those three income sources stack on top of each other. The July adjustments to how mid-year recalculations are processed can change the timing of when those taxable amounts show up, which can catch you off guard at tax time next spring if you are not paying attention now. The good news is that there are ways to manage this. One option is to adjust your voluntary tax withholding directly from your Social Security check, so you do not owe a surprise bill in April. Another option is to look carefully at when you take distributions from your retirement accounts. Taking a large lump sum in the same year you receive your annual cost of living adjustment can push more of your benefit into the taxable zone. Spreading those withdrawals out or doing partial Roth conversions in lower income years before required minimum distributions begin can reduce the long-term tax bite. None of this is one-size-fits-all, and a tax professional who understands retirement income can save you far more than they cost. But the first step is simply knowing this trap exists, because most retirees never see it coming until the tax bill arrives. Let me hit you with something else that gets missed: the earnings test. If you are collecting Social Security before your full retirement age and you are still working, there is a limit to how much you can earn before the agency starts withholding part of your benefit. Many people born before 1975 are working part-time in retirement, either by choice or by necessity, and they do not realize that going even $1 over the earnings limit can trigger withholding. The withheld money is not lost forever. It gets credited back to you once you reach full retirement age in the form of a slightly higher monthly check. But the cash flow disruption in the meantime can be brutal, especially if you were counting on every dollar of that benefit to cover rent, medication, or groceries. If you are in this situation, the smartest move is to project your earnings for the rest of the year right now, before July ends, and decide whether to slow down your work hours, adjust your filing status, or simply plan around the temporary reduction. If this video is helping you connect dots you did not know were there, please give it a thumbs up. It genuinely helps push this information to other people in your age group who need to hear it. Now let me talk about something nobody warns you about, and it is one of the most painful mistakes I see retirees make: spousal and survivor benefits. If you are married, divorced after at least 10 years of marriage, or widowed, you may be entitled to a benefit based on your spouse or former spouse's record, even if you never worked a day under that record yourself. The rules around when to claim your own benefit versus a spousal benefit are tricky, and the order in which you file can lock in a lower payment for life if you get it wrong. For people born before 1975, this is even more important, because some of the older claiming strategies that used to be available have been phased out, while new combinations have opened up. A widow or widower, for example, can often claim a survivor benefit at one age and switch to their own retirement benefit at a different age, or vice versa, depending on which one grows faster. Getting this sequence right can mean tens of thousands of extra dollars over retirement. Getting it wrong, and most people get it wrong because nobody at the office is allowed to give you personal financial advice, can quietly cost you that same amount. The July review window is a natural moment to sit down and re-examine these choices, especially if your marital status, your spouse's health, or your work situation has changed in the last year. Here's a hidden detail that almost nobody talks about. Medicare premiums for Part B and Part D are pulled directly out of your Social Security check before the money even reaches your bank account. If your income from 2 years ago crossed certain thresholds, you pay something called IRMAA, which stands for the Income-Related Monthly Adjustment Amount. It is a surcharge on top of the standard premium. Many retirees see their net check shrink even when their gross benefit goes up, and they have no idea why. The reason is almost always Medicare premium changes, or IRMAA, adjustments based on a one-time income spike, like selling a house, taking a large IRA withdrawal, or cashing in an old investment. If you had a one-time income event 2 years ago and you are paying IRMAA today because of it, you can file an appeal using a life-changing event form, and in many cases that surcharge can be reduced or removed. This is one of the most underused appeals in the entire system, and it can put real money back in your pocket every single month going forward. If you are still with me, you are getting the kind of information most people only discover after they have already lost money. Hit subscribe so the next update lands in front of you the moment something changes, and leave a comment letting me know which of these topics you want covered in more depth next. Let me give you the simple action plan, the steps anyone can take this week, no matter where you live or how much you have saved. First, create or log into your personal Social Security account on the official agency website. From there, you can pull your full earnings record and your most recent benefit estimate. Go year by year, especially through your highest earning decades, and compare those numbers to your old tax returns, W-2 forms, or pay stubs if you still have them. If anything looks off, even by a few $1,000s, write it down. Second, gather your proof. The agency accepts W-2 forms, tax returns, pay stubs, and in some cases, written statements from former employers. The more documentation you have, the faster the correction moves. Third, contact the Social Security Administration directly to start the correction process. You can do this by phone, in person at a local office, or in writing. Keep copies of everything you send. Fourth, if you are married, divorced, or widowed, request a benefit comparison that includes spousal and survivor options, not just your own record. Ask specifically about the best filing sequence for your situation. Fifth, look at your tax withholding from your Social Security check. If you have been surprised by a tax bill in past years, increase your voluntary withholding now so next April is calm instead of stressful. Sixth, if you paid IRMAA surcharges based on a one-time income event, file the life-changing event appeal. It costs nothing to ask and the savings can be significant. Here is the bigger picture, and I want you to hold on to this. Social Security was designed to be a foundation, not a luxury. It is the one piece of retirement income that is adjusted for inflation, protected from market crashes, and guaranteed for life. That makes every dollar of it more valuable than the same dollar from a savings account or an investment, because it keeps paying no matter how long you live and no matter what the economy does. Protecting your benefit is not just about this month or this year. It is about making sure that 20 years from now, when prices have climbed and other income sources may have shrunk, your check is still doing the heavy lifting it was designed to do. The retirees who take the time to review, correct, and optimize their record today are the ones who sleep easier for the next 2 decades. The ones who assume everything is fine and never look are the ones who quietly leave money on the table month after month, often without ever knowing it. So here's what I want you to take away. The July changes are real, the calculation updates are happening, and the people most affected are those born before 1975. You do not need to panic. You need to pay attention. Pull your record, check your earnings, ask about your spousal options, watch your tax situation, appeal what can be appealed, adjust what can be adjusted. And do not assume that silence from the agency means everything is correct, because the system is built on the assumption that you will speak up when something is wrong. The people who speak up get fixed. The people who stay quiet stay underpaid. You have already done the hardest part by sitting through this video and learning what most retirees will never hear. Now turn that knowledge into action this week, not next month, because every month you wait is a month the old number stays locked in. If this video gave you even one piece of information that could protect your benefit, please do 4 quick things before you click away. Tap the like button, because it pushes this in front of more retirees who need it. Hit subscribe so you never miss the next update the moment rules shift. Drop a comment with the question you still have, because I read them and turn the most common ones into future videos. And share this with a friend, a spouse, a sibling, or a neighbor who is also collecting or about to file, because the people you love deserve to know this too. Your future self, the one cashing a slightly bigger check every month for the rest of your life, will thank you for the 10 minutes you spent here today.